Hey, thanks for joining my live stream. It is July 15th, and it's after the market has closed. The market had a mixed day. Only a few stocks rallied today, and most stocks were in the red. If you look at just a few stocks were green. NVIDIA received positive news that it could sell its chips in China, and it really drove NVIDIA stock price higher, as well as Broadcom, AMD, and looks like Micron was also up. The other area that really did well was Microsoft was up, Synopsys was up. The suppliers to the semiconductor space were nice and green because of that news in China. Financials had a big day of earnings. We had big banks announced today, and the whole space was green with one exception. That one exception was Citibank, which was a company that did announce today. Their stock went up 3.68%, although their stocks were down, especially Wells Fargo was down a lot. A couple other green companies, nothing to write home about. Google was up a little bit, 0.24%. Amazon was up 0.29%. GE was up. But there's a lot of red out there. And healthcare just keeps getting beat up. Healthcare could be considered a defensive stock. It doesn't do well when the market is booming growth stocks because a lot of capital leaves healthcare and goes over to the growth stocks, and that's exactly what's happening. So healthcare stocks continue to get slaughtered. Someday they'll come back, but I don't know what's going to happen soon. We'll see. Looks like Kareem Biggins is on. Good to see you. Thanks for joining. And Broccoli Hickox. Good to see you. Thanks for the comments. Now, as I look at the market today, I thought it was going to be the first day of earnings, and meaning that I thought things were really going to start to rally, but it didn't, or rally or move the market quite a bit. And the first day of earnings was kind of a thud. JP Morgan announced, and they did have positive earnings, but their stock traded down. Wells Fargo traded down a lot. Wells Fargo's earnings revealed that the bank isn't doing all that great with new loan origination and so forth. Citigroup did announce really good earnings, really good top line growth, better profitability, good book value growth, and their stock rallied. As we go down the list, there isn't any other big names, so I'll just kind of stop there. Bank of New York also announced, and their stock did trade down for the day. So the big banks I thought were going to set off some buying, and that wasn't the case. So it might be that the economy isn't doing all that great, and that's on the minds of investors. What's also kind of a paradox is the news with financials wasn't all that great. The economy is not booming, but there's still a lot of capital being invested in the data center. Therefore, the stocks that will benefit out of that data center build out just keep getting bigger and bigger, which is amazing. I mean, just absolutely amazing. And as the AI build out in data centers gets built out, it just keeps reminding me of the internet boom, where we saw businesses really invest big in the internet, which was real. It was absolutely real. And it got built out, but there was some pretty drastic pullbacks. There was part of the internet was overbuilt for its time, and some of the internet was overbuilt in certain areas. For example, fiber optic data transmission lines were laid down with the expectation, oh man, this is all going to be needed. And they were right. They were just super early. So the companies who invested in that just got destroyed. And then other places like hardware companies also got destroyed. So just a lot of pieces had to be corrected during the internet build out, which was absolutely real and so forth. So we'll see. We'll see how this AI build out plays out. It's been amazing to this point. Looks like Tomas is on. Thanks for joining, Tomas. Appreciate the comments. I'm glad you liked the video on semiconductors. So just a quick, wanted to share my methodology for anybody who's new out there of what point of view I take on companies and stocks. I'm a long-term investor in stocks. I'm not a trader. So if you see some traders that really deal with technical charts and so forth, I think what they do is great. But for me, I'm looking at trying to understand a business and understand that, hey, they do have very good advantages that could help them, be successful in the future. They have strong moats, competitive advantages. They have very strong fundamentals, revenue growth, profitability, free cash flow. And those things are important to take into consideration. I do that through looking at the companies, discounting free cash flows, discounting profits through earnings per share, and putting that all together in evaluation, and then being able to then make a decision on investing in a company or not investing in a company. So my methodology is from a long-term investment perspective. Now, as we look at companies on today's session, I've got a couple member requests, and I've got them teed up. The first symbol we're going to look at is INMD, and the second one is BCS. Those are two member requests that were messaged to me, and I'm going to get to those. And then I'm going to also hit, if I have time here, I'm going to hit Citigroup as well as Berkshire Hathaway. I think it's a good time to look at Berkshire Hathaway. Looks like Cream Biggins, you want to look at LRCX. We can definitely do that. So LRCX. Okay. Take a look at that. And just a quick note, I managed to get and please bear with me as I get through this cold. So, all right. So let's get started with some individual stock reviews. And I'll go ahead and start with LRCX since that was a request on the stream. And then we'll get over to INMD and BCS. So Lam Research. So Lam Research has been a good stock. Year to date, it's up really nicely. These guys support the semiconductor space by providing machinery materials that the big semiconductor foundries need. And they're headquartered in the US, but do most of their business in Asia, where they have all the big foundries in Taiwan, in Korea, in China, and also in Japan. So these guys have been doing really well. Their stock's been really moving. Up 39% year to date. They had a really nice move coming out of that big sell-off we had in April. The market cap of the stock is 129 billion, and the revenue is 17.4 billion. So you're paying less than 10 times revenue, which is good. The PE ratio is 28. It's a little expensive, not too bad, depending on their growth. So when we look at their growth rate, 20% for the most recent trailing 12 months looks good. They did have kind of a slowing of revenue in fiscal year 2024, which ended June 30th of 2024. So it looks like they're going to end their fiscal year 2025. They ended it, and they'll be reporting it soon. Okay, so 20% growth looks really good. Now let's see what kind of margins they have. And I like to look at margins because the desirability of a business goes up as their margins go up. A more profitable business just is more desirable. So some businesses might have gross margins of 85%. Some businesses might have gross margins of 20%, 30%. Well, the 20, 30% gross margin businesses are all not desirable to me. 85% margin businesses are desirable. It's just the profitability. And these guys are kind of in the middle of the road there. 48% isn't bad and it isn't good. It's just right in the middle. Now, they are profitable. They've been around for a long time. They've been doing what they do for a long time. And they really do keep a lot of that profit in the bottom line. Now, when we look at their free cash flows are good. And I have a full valuation on Lam Research that we're going to take a look at. Free cash flow is $3.79 billion. We have seen kind of cash flows go up and then come down. The trailing 12 months are lower than previous year, really the previous 2 years. Something's going on there with the cash. Maybe they had to retool and put more money into their production facilities and so forth. All right, so that is their cash flow. Now looking at what analysts think of Lam Research. So I like to look at what analysts have to say, but I don't necessarily follow them or make decisions strictly off analyst reports. 25 analysts cover them. They think the stock is fairly priced. Understandable because the stock price has really run up year to date. Stock's really worked. And I owned this stock up until recently. I sold it maybe about a month ago. And maybe I should have kept it. It could have kept going up for me. But I made money on it, so I'm not going to cry about it. Now, looking at their 1 year, one of the reasons I thought Lam Research was a good investment was it was kind of bumping along these low valuations, but it looked like the stock price was set to really start doing well, and it certainly did, so I'm glad to see that. Now, so we went over forecast. The analysts think it's fairly priced. I want to look at the earnings per share and revenue growth, the consensus revenue growth. And Stock Analysis, the website, does a really nice job. So overall, we have 25 analysts covering it. Some analysts think it's got a stock target, price target of $125 per share. And some think it's worth far less than it's currently priced. I want to look at the revenue, how it's supposed to grow. So for the year that is closing, that already officially finished, and they will be reporting it soon, they should have grown their business by 25%, and earnings per share would be $4.10. It was a nice growth from the previous year. This was a down year. But next year, which we're actually in now because it ends June 30th of 2026, they're only going to have 2.8% growth. And then the following year could grow 12%, so forth. The earnings per share is not going to expand very much, $4.14. So that's one thing to consider. The growth isn't very good in the current year and future years. All right, so let me take a look at Lam Research's valuation now. So this is the valuation I have, and I haven't covered it, but I'll tell you about the paid member perks later. But one of them is you get access to the research that I have, so you can actually look at this on your own if you wanted to, 24/7. Now, I think the stock price is priced a little too high, 9% at this time, which is one of the things that led me to sell the stock after making some money on it. The free cash flow that I expect is good. The free cash flow in 2024 was a little over $4 billion, and I build a free cash flow forecast based on the free cash flow they're producing. They grew nicely, and they're expected to grow slowly but continue to grow. So this cash flow could expand this way. Growing by 10% might be a little too optimistic. Looking at the growth rates we just covered, it might be a little optimistic. So I'm gonna tone that down to about 7% because I looked at the growth rates that Consensus had on the company. They were going to grow just barely about 2% the current year, and then 12% after that. So I'm going to go to 7% there, and then stick to that number. So that'll tone down the numbers a little bit. Now, this is your projection of all the cash flows in the future. But to get a current net present value of what those cash flows are worth, I use a discount rate of 8% to get to a net present value of all those cash flows in today's value. And that is $102 billion. Now, the cash on the balance sheet I'm going to add, I'm going to take away debt. Equity value is therefore $103 billion, which is the net present value of cash flows plus cash minus debt. So that's below the current market cap. So based on cash flows, the stock's priced too high. Earnings per share is actually better than that this year. It was $4.14. PE of 24. It wasn't going to grow that great, so I'm going to change it to 7%. So overall, I think the stock is priced a little too high. Now, semiconductors are flourishing. Semiconductor companies are flourishing. A lot of momentum to the upside. And again, I'm a long-term investor. I want to buy stocks that are really great companies that are going to continue to grow. And I thought Lam Research was a good investment, but it doesn't overly excite me. It's just going to follow the market, so to speak. When it comes to semiconductor, I'm more excited about ALAB, ALAB, as well as Qualcomm. Those are my two exciting semiconductor stocks. Lam Research is a good stock, a good company, but I think right now it's just priced a little too high. I invested in it, I got out of it, and I moved on. So those are my comments on Lam Research. So hopefully, Cream Biggins, you found that interesting. And again, as I mentioned, I have a cold, so I'm going to be clearing my nose and so forth throughout the live stream. Sorry about that. All right, so moving on. David Knight, AMD is the one. I've heard good things about AMD. I heard their technology is getting better and more comparable to NVIDIA, and we'll see if they can pull it off. One thing I would say about AMD, I've heard about AMD taking on the dominant player for 30 years. That's been the story of AMD for 30 years. It used to be, will they ever catch up to Intel? Man, they're getting better, they're getting better, they're getting better. They never caught up to Intel when it comes to PCs. And even in the data center, Intel is installed in so much commodity hardware. So now the story is, can AMD catch up to NVIDIA? Well, it's been the same story that I've heard for 30 years. Not to take away from their current success. I don't want to overstate that. All right, so we went over Lam Research. And if you guys want to request a stock ticker to be reviewed, just put it in the chat. If you're a member, they're free. That's part of what you get as a member. If you're not a member, a $5 super chat. Then I'll review it, similar to what we just did with Lam Research. We'll go through, kind of look at the business, see what they're all about. Are they a highly desirable business, low desirability, and so forth. And before I move off of that, let me see if I can quickly move that. I'm going to show you the desirability of Lam Research along with other semiconductor companies. All right, so I happen to have this ready because I had created a semiconductor video. So let's take a look at this guy. All right, so here's kind of the semiconductor space and a lot of companies that we all know and love. NVIDIA being the top dog, and these guys are so incredible. They have a unique accelerated compute in the GPU that is really, really red hot right now. So many companies are buying it. And the other things on within the semiconductor space, we have ASML, which makes the machines for the semiconductor space and so forth. Broadcom is in here. And where I have Lam Research is it's a good business. It's in the gray, which is a moderate desirability. It's not like their product is booming. Not at all. It's a good business. It grows moderately, and at times it does well, but at times it has pullbacks like we just saw last year. So that's why it's a moderate desirability stock. It's not a booming stock like a Nvidia or even an Astera Labs. It has really good technology that is red hot and they're growing at 200%. So that's where I put Lam Research from a desirability perspective. All right, so let's go over to the next stock. Let me check comments real quick just to make sure answering any questions. All right. So again, good to see you, Tomas. Good to see you, Cream Biggins. All right, cool. All right, so let's take a look at InMode Ltd. And these guys are, they design, develop, manufacture, and market minimally invasive aesthetic medical products based on its proprietary radio frequency assisted lipolysis and deep subdermal fractional radio frequency technologies in the United States, Europe, and Asia, and internationally. The company offers minimally invasive aesthetic medical products. Okay. Let's take a peek at their website. And this is a member request. And so let's take a look. So this is their device. It's a med device. Okay. So this is for skin rejuvenation. All right. So it looks like it's used for beauty and, you know, for, I imagine, just people, and I want to say ladies, but I don't want to be sexist, that want to look better, want, you know, better skin and so forth. All right. Interesting. Okay. Well, this is probably being sold to doctors that provide this type of treatment. This is likely a treatment that is a cash basis treatment, meaning you don't go through insurance. It's just somebody who can afford it goes in, buys the treatment, and then they're good to go. So that's the kind of product we're dealing with. Let's take a look here. Providers. All right. So we have, so as I look at a business, I first, you know, want to understand, you know, what are we dealing with? Yeah, we're dealing with, you know, the type of treatments that are optional. These are for people that would like to look better, maybe make some changes. Okay, got it. And these are products that, you know, if they are in demand, they're quite profitable for both the doctor, the physician that provides it, because it's a cash business. They don't have to deal with insurance companies that are going to discount things and so forth. So now that we know what kind of business we're dealing with, let's get into the fundamentals. Okay, so InMode, and give me 3 seconds. All right, just had to clear my nose there. As mentioned, I've got a cold, but let's carry on. All right, so InMode got stock's been down today, but rallying in after hours. Over the 1 year, it's down 20%. Over the 5 year, boy, it really ran up a couple of years ago. And since then, it hasn't done much. It is a super small cap, under $1 billion, and they have revenue of 392. Okay, and I forgot to see where are these guys headquartered. So they're headquartered in Israel, founded in 2008. They IPO'd in 2019. Okay. All right. Looks good. So the revenue is 392. They are profitable. P ratio is super low. Man, I wonder why stock has not caught a rally. PO's really low. The price targets are 23%. We'll see how many analysts are weighing in on that number. Now, one first concern is why is revenue dropping, right? So we have full year 2024 revenue dropped almost 20%. And that's after the business was growing nicely. Remember the chart I showed? The business was growing really well back in 2021. It continued to grow, but it started to slow down. Then the stock really sold off. Okay. Well, this is a red flag for me. Usually, this is a small business, and um, why is the business not growing? Is it that the treatment doesn't work? Is it that it's just not popular for doctors to provide this type of treatment? So those things are a big concern. Now, I don't know the science behind it, but I do know fundamentals. And declining sales are usually bad news. So it is bad news in my book that their sales are contracting. So free cash flow, the company does have positive free cash flow, $121.95 million in the trailing 12 months. Gross margins are really good, and 80% is really good. So that looks good. Okay. So the company is profitable, good cash flow. The biggest problem I see with them is that declining revenue. What's going on? And for looking at the quarterly, looking at the last 6 quarters, 5 of the last 6 quarters have been contracting sales. That's not a good sign. What's going on? What's wrong with the product? What's wrong with the market not like the product? There's questions that have to be answered. I've worked too hard for my money to invest in a company that is going to go down in price and take away my capital. And this is a first big question that has to be answered. What's happening with revenue? How are you going to begin to grow? And I need to be convinced of that. Right now, this is a big showstopper for me, but let's carry on. Let's carry on. So we have declining sales. Let's take a peek at the balance sheet. Now, the reason looking at the balance sheet is really important is you can have a terrific business with too much debt, and that business can really struggle just because they're somewhat of a slave to that debt, making those debt payments. So the cash on the balance sheet's 512 million. Debt's only 5 million. That's excellent. So the balance sheet's in really good shape. Looks good. All right, now let's take a look at what 6 analysts cover the stock. And I'm a little surprised that 6 analysts cover a tiny company like this. And one analyst really has them going up in value to $24 a share. That would be a really nice win for investors. The worst case scenario has them trading higher than their current stock price. So on average, they believe the stock price is discounted by 23%. Now, when we look at what consensus growth rates are going to be, and it looks like 11 analysts are weighing in on the expected growth rates for this company. This year, they're going to stabilize. And then next year, they're going to start to grow. And then the year after that, grow. So that looks good. I would say that if this happens, that's a very good sign. And earnings per share is going to come down a bit and then begin to grow. So that looks good. Now, if they can grow by these amounts, this could be a really nice investment. Has a really strong balance sheet. The profitability is really good at 80%. So if they start to grow, this stock should do well. Now, one thing about healthcare stocks, they've just gotten beat up, royally. And as mentioned early in the live stream, as technology growth stocks have been flourishing, they've been taking capital away from healthcare, staples, and utilities in general, and other spaces or other areas of investment. It's just pulling away capital. Healthcare tends to be a defensive stock, and capital will flow to it when investors are afraid that growth stocks are going to really go down in price. And right now, that's not the case. I think investors are, they have FOMO. They're fear that they're missing out on those high growth stocks, and they're piling into them. So for now, healthcare isn't booming, and that gives us time to kind of watch this stock and see if it's going to go places. This would be a good stock to watch, and if they do provide growth, it might be a really good investment. They're going to announce their earnings on July 30th. That'd be the first step in seeing, yeah, these guys going to start to grow. If they are, this might be a really nice investment, because, and I'm going to switch over to this view because I like the charting on Google more than stock analysis. So this stock, I mean, it was booming back in 2021. There was a boom in stocks coming out of COVID, and they were growing nicely. So it's not completely irrational that the stock was trading so well. But since then, the stock's really beat up, down 84%. Now, for the past year, the declining sales have really hurt the business. And more recently, the sell-off in healthcare, I'm sure, has really affected them as well. So I think if you're looking to invest in healthcare stocks, the one thing I would say is you're going to have to be patient, because the market is really in love with growth stocks in technology and other sectors. But healthcare stocks are not getting a lot of love these days. So that's totally explains the charts and where the stock has been. I think if these guys figure out how to grow, and I would study their earnings releases and see if it's rational to you. Hey, is what they explained, make logical sense? Then this might be a really nice pickup. It's a tiny cap, so they can go from under $1 billion to a $2 billion valuation very quickly. But we first need them to start growing the revenue, and that could help a lot. And we also need to see a rotation of capital leaving some growth stocks and coming back to healthcare. So I think patience is going to be needed if you're going to be an investor in healthcare stocks. So that's InMode. Just to look at one more area of InMode, if we had to value stock, just back of the napkin, back of the envelope kind of analysis, the free cash flow for a year is 122 million. And if they're not growing, right, they're just kind of stable, maybe you pay 10 times free cash flow, which would be $1.2 billion. If they're a growing stock, boy, you can pay $2.43 billion plus or minus cash. And they have $500 million cash. So this really sets up as a really value play. If these guys just start to grow a little bit, be worth 1.2 billion plus that 500 million they have of excess cash on the balance sheet. So we're up to 1.7 billion dollars in value. Very easy to understand that. and they're trading. Their market cap right now is 900 million. So just to step up to a reasonable valuation would be like a doubling of the stock price. So this one is interesting and I think worth watching. So it is a good watch stock for me, and I'm going to be watching it going forward. I would like to see them figure out how they're going to grow the business. And if they figure that out, then it might be a good investment. But again, investing in healthcare stocks right now, you got to be patient. So that is InMode. Good one. So that one came from a channel member that is in the UK, and it's a really interesting stock. I think you're tapping into an interesting stock, and if it does the right things, that could be a really nice, rewarding stock. These small caps can double in value, triple, quadruple very quickly. But you got to do your homework. You don't want to buy something that's going to continue to go down in value. All right, let's move off of a small cap. Let me check comments just to say hello to some people, and then we'll move on to the next stock we're going to look at, which is BCS. All right, Broccoli, good to see you. Thanks for the messages on chat. Hugo, oi, oi, good to see you. Neil Weston, good to see you. And David Knight, good to see you. All right, so we're going to look at BCS. That's Barclays PLC. So Barclays PLC provides various financial services in the United Kingdom, Europe and Americas, Africa, and Middle East. The company operates through Barclays UK Corporate Bank, Private Bank, Wealth Management. Okay, so they're a big bank. They've been around for a long time, 1690, and they're a diversified bank. So a lot like a JP Morgan, maybe a Bank of America. They are located in England. Market cap 64 billion, revenues 32 billion. PE ratio is really low, 8.9. That is nice and low. I'm going to compare them to American banks that we actually had several announcements today from JP Morgan, Wells Fargo, Citibank, and Bank of New York. So I can compare the fundamentals of Barclays over to those banks, see where these guys stack up. So these guys pay a nice dividend of 2.31. And since these guys are a UK bank, and we're going to be looking at, so this is in US dollars there. This is in the GBP currency. I mean, so we'll just look at percentage growths, but then I'll convert it over to US dollars when I look at the metrics. All right, so overall, the business, let me get my bearings straight here. So total revenue is represented on this line. This is the income statement. It looks like they've been growing nicely. And this is a big bank, so a couple percentage of growth is good for these guys because they're so big. They grew okay in 2024, but their growth is even better in the trailing 12 months. So that looks really good. 7% growth on a big bank. All right, that looks good. Now, when we look at banks, we don't value based on free cash flow. I look at book value, and I also look at earnings per share. So before I jump over to those metrics, let me go over a few more things. Let's look at the forecast. No analysts are providing any kind of guidance there, so we'll have to skip that. All right, so this is Barclays. I like their revenue growth, top line revenue. Now let's take a look at the valuation of Barclays, or at least comparing Barclays to other banks. So today I was able to update because we had earnings on Citi, Wells Fargo, JP Morgan, and Bank of New York. And here are their metrics. And we want to look at book value and price to book and the PE ratio. And the best, I think, valuation, the best valued big bank stock in the U.S. is Citigroup. It's got a price to book of 0.85. You want this as low as possible. And the P ratio, of course, we want a low PE as well. And the most valuable company is JP Morgan, and its price to book is 2.34, which is much higher than Citi. This is an $800 billion market cap bank, where these guys are below 200 billion in market cap. PE ratio 14.83. So the PE ratio looks somewhat close to the average within the industry, but their JP Morgan's book price to book ratio is really high. The best one is Citigroup. Now, just to kind of show, Citigroup today had a nice rally, while JP Morgan and the banks didn't. It went up 3.68 after announcing earnings, but the other banks sold off. Now, going back to comparing Barclays, and when I look at the price to book for Barclays, it's even lower than Citigroup. So that looks really good. And then the PE ratio is lower. So it's a 9. So Barclays looks like a good investment if you look at the ratios. And I'm invested in Citigroup, and I like investing in country as my first choice because I don't know Barclays as well as I do Citigroup. I can't manage it and be aware of anything that's happening with the company. So I think I'm going to sit tight with Citigroup. But Barclays, it looks really good. From fundamentals and ratios, it looks really good. So if an investor was very comfortable with Barclays, I could see it being a good investment. Let's see where the stock's traded over the last couple of years. So over the 1 year, this is doing really well. It's up 57%. Over the 5 year, it's up 219%. So this stock has really rewarded investors, and the fundamentals show that, hey, it's still, compared to U.S. banks at least, it's still underpriced compared to U.S. banks. Now, is the economy in the UK doing well? I don't know. I think that would be an important factor. Is the climate for banks in the UK and other areas where these guys operate, is it positive or negative toward banks? That's something to consider. And that's one of the reasons why I prefer to invest in my home country in the US, so that I do have that at least comfort level of, for example, in the US, the regulation on banks is getting easier, better for banks. So that's a positive. And I'm aware of that because I'm in the US and I follow what's been happening here. I also follow the economy here, right? The economy is growing just a little bit. It's not setting any records, but the economy is doing decent. The inflation report was released today. The inflation report was okay. I don't know that in the UK. I don't have that comfort level. But if you're in the UK or like investing in the UK and have that comfort level and you feel like, no, the climate for Barclays is going to be good, I can see this stock continuing to go higher because the economy in the UK and wherever else they do business is going to help them continue to grow. Their growth rate did look good in the last trailing 12 months, so that looks good. Now, they're going to announce on July 31st. So in a couple weeks, you can hear what they have to say and see what they have as an update on their growth and where they aim to grow their bank. But I think Barclays looks like a good investment if everything else holds up. The economy's doing okay in the areas they're doing business in. Looks like a good good opportunity. And you know, I know that a lot of the tech stocks are taking a lot of the attention, as they should. You see certain stocks go up 1,000% or even more. They should catch everybody's attention. But you look at these banks, they're doing really well. If you're an investor in Barclays over the last 5 years, you did really well, up 209%. That's really good. Rate of return of more than 40% per year. Yeah, that's getting it done. That's getting it done in my book. So, yeah, so that's Barclays. Thanks for bringing it up. I think it was a member on a comment to one of the videos. I think it was the video I did on big banks. He asked if I could take a look at BCS, and hopefully you found my review interesting and helpful. All right, so it looks like Genetic Smite is on the stream. Good to see you. And I think I'm caught up on comments there. DJ Mix, thanks for joining. I think I provided the responses to the request out there. Again, just a quick reminder, if you are a member, you can ask for stocks to be reviewed. That's part of the member perk. If you're not, $5 super chat, take a look at a stock. We can go and review it from all angles. Or you can become a member. Then boom, you can request the stock ticker to be reviewed on the live stream. So if it's something you're interested in, just visit the homepage of my channel. You hit the join button, and then you can get the information on becoming a member. Anthony Ferguson, Tony, how are you? Yeah, so I think your question, so healthcare has just been getting killed. And I think part of it is there's so much capital moving over to tech stocks that United Healthcare just keeps going down in price. Just really, really been sold off. I bought more shares of United Healthcare today. But yeah, it's been just getting smashed. And all of healthcare has been sold off. You see, today, here's a healthcare heat map, and it is not looking good. A lot of the stocks, these are the pharmaceuticals, they sold off. And let me try to get out of that guy. So healthcare, you know, the healthcare payers, insurance payers, they sold off, but United Healthcare sold off the most. Just all of healthcare, it's been really sold off. So I think healthcare, unfortunately, it's going to take some patience to see a good return come out of healthcare. And it's one thing I think investors should pause before deploying more capital there. It's just been rough. The market is just in love with these growth stocks, and capital is flowing into those growth stocks, even though, you know, they seem really expensive. So that's one thing I've noticed as well, Tony. And again, it might take a little bit of patience, but boy, if we get another, you know, big sell-off like we saw earlier in the year, that's where healthcare stocks will come back, because they tend to be a defensive stock. You have a good sell-off, we could see that really move. And it could, you know, it could be around the corner. One thing that I noticed about this earnings is I thought the banks were going to announce better earnings than they did. JP Morgan sold off today. So did Wells Fargo. So did Bank of New York. And it's not, I mean, it was just day one, right? So we'll see what other companies say. But if we have a consistent message that earnings are not as good as expected, because I was expecting banks are going to do well, maybe that puts the market into a downward trend, and we see a correction of some sorts. So, you know, more to come. We're on day one of the earnings season. This was the big banks. This tends to kind of set the table because these are banks. So if their volumes of loans and so forth are higher, that tends to mean because commerce is higher. That means the businesses that are going to follow to announce are probably going to be doing well. Tomorrow we have Johnson & Johnson announcing, that's in healthcare. Bank of America, ASML, that'll be super interesting to see. Are they seeing more orders for their semiconductor making machines? Morgan Stanley, Goldman Sachs, Progressive Insurance, that'll be tomorrow. We have United Airlines. Delta announced earnings, I think it was last week, and those were really good earnings. And I think those are the big ones. So yeah, so healthcare is just getting beat up. But again, I bought more United Healthcare. I'll continue to buy it because I think that one's going to be a winner. It's just going to take a year or two. Looking at earnings just a little more on Thursday, we got some big names. We got TSM, the big semiconductor foundry in Taiwan, Netflix, General Electric, Novartis, Abbott, Pepsi, and some other names. Interactive Brokers. This stock's been doing really well. Elevance Health, that's a stock that I own, and it'll be if they put up a good growth number, it'll just go to show that healthcare stocks are really worth a lot, but the market just doesn't like them right now. There's a preference to go to growth stocks in technology versus buying good solid businesses in healthcare. US Bank will announce. So we got some interesting names coming up on Thursday. And then on Friday, American Express, 3M on Friday. It's one of the stocks that I own. Ally Financial, Charles Schwab also on Friday. And next week it gets even more busy. On Monday, you got Verizon, NXP Semiconductors, Domino's Pizza. And I have a niece. It's actually my nephew's little girl, and she swears by Domino's Pizza. Cracks me up. She's 6 years old and believes she's an expert on pizza. So then on Tuesday, July 22nd, we have SAP, the big software company, announcing Coca-Cola, Philip Morris, RTX. Got some big names. Wednesday, one of the first big mega caps, Google, is announcing on Wednesday of next week. Tesla, T-Mobile, IBM, ServiceNow. And it's just going to stay busy from there. And on Thursday of next week, we have Blackstone, Honeywell, Union Pacific, Intel. Then on Friday of next week, we have HDFC Bank. Never heard of them. All right, nothing I recognize there. So it's going to get nice and busy with earnings. So, all right, so it's going to get pretty busy. All right, so Carlos, good to see you. So Trade Desk is going to enter the S&P. Well, that'll help the stock price because it'll automatically be bought by all the ETFs that are pegged on the S&P. So that's what I would expect there. Michael and Anthony, good to see you. Anthony, 6 is a pizza eater's prime. Yeah, you know what? You're right. I should take her opinion more seriously because you're right. Like that little girl could eat pizza, for every meal of the day for, the next year for sure. So you're right about that. All right. So I wanted to get into Berkshire Hathaway. And one thing that started pretty much, Berkshire Hathaway has their annual meeting. And this year they had it at the very beginning of May. And here's May. So very beginning of May, you had the peak of the stock price. And Warren Buffett, as expected, I mean, the guy's 94. He basically said, hey, I'm not going to be as active as previously, and I'm going to pretty much hand everything over to my successor. Message received. And since then, the stock's down 13%. Now, it's not a complete collapse, right? But keep this in mind. If you compare that to, other stocks, let's say a Microsoft during the same time, these stocks are going in opposite directions. Microsoft during the same time is going up, and Berkshire Hathaway is going down. Two high quality stocks, two name brands, but the differential is pretty staggering. One going up, one going down. And I think that the Buffett premium is going away. And, both Charlie Munger and Warren Buffett built Berkshire Hathaway. Boy, did they build a powerhouse company. And they have legendary investors. But without them in the company, it doesn't differentiate Berkshire Hathaway anymore. The new successor, I'm sure he's really good. He just doesn't have a reputation and a track record that would compel investors to pay a premium. You don't have Warren Buffett at the helm anymore. And that's what I think you're seeing leave the stock. And I mean, Berkshire Hathaway, when we look at the fundamentals, it's a $1 billion market cap company, revenues of 371. PE looks pretty reasonable. Analysts think it's discounted by 12.29%. But when I look at the valuation of the stock, and from an investing perspective, I have respect for Warren Buffett that is, pretty fundamental, because I've been studying Warren Buffett, reading about him, and trying to study how he was successful, for 35 years. And I can tell you that everything I read about Warren Buffett, I like. But I don't make investments exactly the way he makes investments. I think there's a lot of lessons that he has taught us, and I appreciate that. He's been super generous with how to be successful. And but when I look at his company, I'm looking at fundamentals. I think the stock is priced 24% too high. And I say it with all respect, and I'm using a lot of the principles that Warren Buffett has said we ought to use, which is looking at cash flows, trying to get a good forecast of future cash flows for a company, and then discounting those cash flows by a rate of return that we want from that stock and we believe is a fair discount rate to use against a company. And once I do that, add cash and take away debt, I get to a certain value for Berkshire Hathaway based on its cash flows. It's much lower than the current market cap, much lower. The earnings per share number does give them a different valuation because profits come up with a different valuation, a higher valuation. But when I blend the two, taking more weight in free cash flow, it's priced too high. Now, at the meeting that they had in May, a comment that Warren Buffett made that rung really loud with me was the journalists were asking Warren Buffett, hey, how come you're not buying back stock of Berkshire Hathaway? And his response was, because I don't believe it's being priced at a bargain, meaning he didn't believe it's discounted. And most cases, the stock is either discounted or it's priced at a premium. Rarely does a stock ever hit the equilibrium where it's fairly priced, perfectly priced, right? Maybe it does for a week or so, but soon after that, it's either priced too high or too low. So that was a different way of saying, Warren Buffett himself saying Berkshire Hathaway was priced too high, to the point where he didn't think it was a good idea to buy back shares. So he made that comment. I heard it, and I'm not going to make a big deal out of it, but that just kind of goes along with the fact that, hey, I value Berkshire, and even at the valuation that I come up with, it's a really valuable company. And it's been interesting to see the stock price really come down. I created a video shortly after this and put out my analysis, and it's Interesting to see the stock sell off during a time when stocks have really been in rally mode. You would think that Berkshire would be doing better. Their biggest problem has been their investment in Apple, right? So, and before I get into Apple, Saeed, good to see you. So you own Barclays, huh? So I have Barclays shares, but with lower interest rate growth. Okay. Well, hopefully you've been getting all those really good, returns, at least the appreciation of stock, and you're doing really well with the stock. That's another reason I think I mentioned when I looked at Barclays. The reason I like to invest in country is I know the interest rate environment. Well, I don't know how interest rates work and how they change them in the UK. I'm sure it's similar, but there could be some significant nuances that I'd be surprised by. But I know Saeed, you're in UK, so you'd probably be better positioned to invest or not invest in Barclays. If you're invested in Barclays, based on the chart that I looked at, you're doing quite well. So congratulations on that. Hopefully you've owned the stock for some time. Maybe bought it in 2023 and saw that really nice rise from $8 a share up to 18. So thanks for weighing in. Coming back to Berkshire, and the Apple stock has been a stock that has lagged the market because they're not growing their revenue. And they haven't been growing the revenue for a couple of years. And now it's clear that they don't have an overly impressive strategy for growth. They don't have a solid strategy for AI. And those two things, I mean, I would be freaked out if I was an Apple stockholder. I'd get out of it because one of the first things that I want to do as an investor is understand the business and understand, do I think that business is going to keep growing? Do I think that business has competitive advantages that are going to compel it or enable it to grow because it has those advantages against its competitors in a really good market? And that's where you kind of hit a wall with Apple. They're not growing. Other competitors exist in the phone market, like Samsung, even Google has the Pixel, and other manufacturers around the world, like Xiaomi, which has been doing really well, as well as Huawei in China. So Apple has not had a growth-related strategy for a while. So this stock has really lagged this year, and I wonder if this is going to be a trend that we're going to see long term. It was just a rocket ship, right? I shouldn't say rocket ship, but a good stock. And this is a stock that Berkshire Hathaway is a big investor in. I think that's what's been ailing the Berkshire Hathaway stock. But what's going to happen going forward? This stock I think could continue to trend down. I think Apple, we could wake up someday and it's a $1 trillion market cap company, which would be a huge loss to investors. But if you're not going to grow, what's going to happen, right, is the phone market gets really competitive. And again, as mentioned, there's plenty of competition for Apple to face. They don't have any new product. It's not like, oh, well, they're going to come out with this new product that's going to be a growth catalyst. Where rival companies to Apple, and I shouldn't say rival, I would say companies that are comparable to Apple in its size, its market cap, and so forth, you see them continue to reload with ideas. Look at Microsoft. They fully reloaded with AI. They're loaded. They reloaded with public cloud. They're one of the leaders there now. They didn't rest on their laurels, which is primarily their software business. They continued to reload and rethink, hey, how can we create new business revenue streams? They're going to help us grow. So Microsoft, good job. Apple hasn't done that. They continued to, kind of live off the iPhone. And as great as the iPhone has been for them, that's a pretty vulnerable strategy. If the iPhone stops growing, you're done. You don't have anything else to grow. Their computer business, laptop business, that hasn't been growing very much over the last 30 years. So, I don't even know if they make desktops anymore, but that business is not going to bail them out either. iPads, not a lot of iPads are sold. So Apple, I think, is kind of in a spiral downward. I don't think that spiral is going to end for a while. Maybe for a couple of years, the stock's going to trade down, and they'll be less relevant quarter after quarter. When do they announce? It'll be interesting to see when Apple announces. So they're going to announce on July 31st. So it'll be really interesting to see what they come up with. One of the observations I have, it's not a criticism, it's just, call it what it is Apple is in a technology industry. Like, for example, NVIDIA is led by a technologist. Jensen is an engineer. He's brilliant. He's awesome. Apple was founded by two really innovative human beings. And Steve Jobs is the one that kind of pushed the company forward. Steve Jobs was a creator, an inventor, and also a really good sales guy. Well, Apple currently has leadership from a professional manager. He's great, but he's not a creator. He's not he knows how to create things. He knows how to break things and recreate them as a better, more valuable product, or better, more valuable version, where Steve Jobs was willing to break things in order to make Apple better and stronger. So I think that's a reality. Now, can they bring in a CEO that can really reshape things? I don't know. I don't think it would work, because some of these great companies are either culturally, they have like just a passion for creating new products. I think about Google. Google hasn't kind of stayed with search and rode search until it collapsed. Google acquired YouTube, made it great. Now it's the number one streaming platform. Google got into the public cloud business. Now Google Cloud is a nice growth engine, and that's really good for Google. Google started the Waymo service. They started developing that like 10, 15 years ago. So Google's just culturally continued to innovate, make big bets, and created new businesses that are now potentially going to help them grow going forward, including a very strong AI business. That's a culture of continuing to find new businesses and be able to continue to grow the company organically. And it's a diversified product portfolio for Google. That's not what Apple's done. Apple's really depended on really one line of business, which is that iPhone. And we'll see where this story goes, but I don't think Apple's going to be the dominant force in the universe that it was maybe 3 years ago. I think those days are behind us. I think what's going to dominate going forward, I mean, AI is the whole craze. We'll see how far and how that changes behavior, as how we work with software, how we work with data, how we work online with apps, and I think that's going to change it. So that is Apple, and I got to Apple because I was talking about Berkshire. I want to talk about Berkshire. All right, so All right, so good to see you guys online. All right, so I'm going to go over Citigroup. Maybe we end there. If you're a member or you're on the stream and you want me to look at a stock ticker, I'll do kind of a last call. It'll probably take me 5-10 minutes to go through Citigroup. But this is the last call for paid members. If you want me to look at a stock, please put the ticker in the chat and I'll check over the next 5-10 minutes. And if no new stocks come up, we'll go ahead and end at that point. All right, so Citigroup came out with earnings today, and the stock went up 3.68. And what I like about it, it looks like Tomas, you got a stock. Glad to look at Upwork. Just give me a minute here, and we'll look at Upwork. So Citi going up on a day when JP Morgan especially went down shows that their earnings were really good. JP Morgan went down. JP Morgan also announced their earnings. JP Morgan is the big valuable company or bank in that industry. So it's a lot of credit to the Citigroup management team for continuing to grow the bank. Citigroup reset their strategy. And the reason I got out of JP Morgan and into Citi is that I thought this was a counted out bank that had a lot of value ahead of it. And I was right. I invested in it at the right time, and now the stock's up nicely. But JP Morgan was a good investment for me for a long time. So I'm happy with the results that I had there. Now, these guys, they delivered, I think it was 8 or 9% top line revenue growth, which was really good. And their price to book ratio is the best out of the big banks in the US. So that's one of the ratios that I use, and it really did lead me to a good investment by following that price to book ratio. JP Morgan is the most expensive in the lot. And part of it is because so many investors trust in JP Morgan. Can't argue with that. But I'm looking for value. I'm looking for a stock that's going to do well over the next 5 years, not a stock that's done well over the last 5 years. The last 5 years is good data, but it's really about looking in the windshield when I'm driving the car. Look forward through the windshield and not make investments exclusively looking at the rearview mirror of data for the last 5 years. So Citigroup was a good call, and I'm glad that I invested in it. And today was a good day. It showed that, hey, you know what? Citigroup is on the right path going forward. And I actually bought shares of Citigroup yesterday, leading into the earnings call. So I think Citigroup would have made my day if it wasn't for Alibaba. Citigroup was good news, but Alibaba was terrific news. I'll cover that after I cover Upwork. So Upwork is a company. It's a new industry, right? Now we have a connected world. You have people that can do gigs, can do tasks, can get things done for other people around the world. And Upwork connects people that need things done with people that can perform that service or that project. Now, I think it's a neat model, but the market has not agreed with me. The stock is down 21%. Over the last 5 years, this stock's really sold off. Coming out of COVID, it seemed like these guys were going to flourish. Everybody was stuck at home. And I'm sure a lot of people that were stuck at home were willing to do some gigs, do some work at home, whether it's a computer programmer or whomever, they could do those things remotely and do that job. But once we got back into the office, these guys have really struggled. Now, is this the chart? Does it match the business? Is the business collapsing or is it growing? Let's take a look. P ratio is super low. Man, how low can it get? And if you have a P ratio, that means you're making money. So that's the first green flag. Market cap's 1.7, revenues 771 million. So you're paying less than 3 times sales. Now this business is growing, but it's not growing a whole lot. I think that's what the market's really nervous about. Last quarter, they just barely grew. But I mean, if these guys can figure out how to grow, this business is worth a lot more. when we look at their business, right? So they're not growing. That's a red flag. Okay, why aren't you growing? This market should um, be very fertile, and the total addressable market, I imagine, has to be there because nowadays employers are looking, or businesses are looking for lower cost options to getting things done. Well, this is a lower cost option to getting things done. You don't have to hire somebody full time. You just need something done for the next month or 2 months. So the whole logic of this industry makes a lot of sense to me, but the market, and part of it is that the business hasn't been executing really well to grow. They got to figure out how to grow. If they don't grow, the stock price isn't going to go anywhere. When do they announce their earnings? August 6th. So we're 3.5 weeks from that date. They got to show how they intend on growing. Now, aside from the growth, let's take a look at their margins and then cash flows. So their gross margins are really good, 78%. That's really good. That means really good gross margins. Profit margins are excellent. Free cash flow margins are really good. $170 billion of free cash. So they're priced at 10 times free cash flow. Let me double check their balance sheet. See how much debt or cash they have. They have a surplus of $251 million of cash. So they're priced actually at like 8.5 times free cash flow. That's super low, meaning this stock is discounted in a big way. Now, that's my opinion on the stock and how I look at it. I think this is a terrific little business. If they can figure out how to grow, this stock can really go places, easily double, triple, quadruple an investor's money. But we need the stock to grow. We need the company to grow. I'm sure Upwork executives are like, how do we grow? It's easier said than done, right? Now, they're a small business, so growing is not impossible. They're a small business. When I value the stock, it's highly discounted by 59%. Now, I bought this stock in my 25-year-old son. I manage his portfolio, and this stock is in his portfolio. That's where I think of the company is. It's totally, if this business works, this can be a 5-bagger, can be a 10-bagger. But the planets have not aligned for Upwork. Things haven't come together as good as they could for the company. Part of it is the company's got to grow. Figure it out, guys. You're a small business. You got to keep growing. And if you can start growing, I think the market's going to pay attention because there's just too much value here. On the flip side, if they announce on August 6th and they have a contracting business, got to stay away from the stock because what's going on? How did you go from growing so fast to now having negative growth? That would mean that the market's going to totally stay away from you. You would be just a company that is going to bump along the bottom and not really go anywhere. See, they had really good growth going into COVID, and then COVID bumped up the growth after COVID. And then they stopped growing, which is kind of a surprise. If they can kick up that growth, then we got something. So for me, it's if you understand their business and feel like I think their business is going to do well, it's a total buy. If you are, well, let me wait a little bit and let the fundamentals tell me that they're going to grow. I would wait for their earnings to be reported and then make a decision at that point. Because if you're a little late on this stock, it's no big deal. The stock is so sold off that if it began to rally, this thing could go up to $30, $40 a share, and you'll make plenty of money at that point. So those are my comments there, Tomas. It's a stock that I hold through my son's portfolio. I think it's a really good business. I think it's going to exist going forward because this makes a lot of sense. I think employers, would want a service like Upwork. So thanks for asking about that. Hopefully that was useful. All right, so we went over Upwork, and just to end the session, I mentioned what was my favorite stock of the day. Well, for me, it was Alibaba. Alibaba was up 8%. Nice. I own a number of shares of Alibaba. And the reason for it was they have a big investment in an AI app in China. It's called Moonshot. And Moonshot came out with their Kimi AI model, and it showed that it beat ChatGPT and Claude in coding, which is what that particular AI app does. So it was very good news for Moonshot, and that means Alibaba owns a big portion of them. And now Alibaba has that as just an additional business that could really go places. Alibaba does have a large language model. They do provide that. And they provide a lot of other things too, but primarily they're an e-commerce business. I hold Alibaba, I hold Amazon, I hold Mercado Libre, and those are stocks that I don't see myself selling in the future because these are businesses that they're just going to keep getting bigger because the addressable market in those businesses keep getting bigger. And Alibaba has really good competitive advantages. I really like the business. So I'm glad it was up 8%. This was my big winner of the day, both from a dollar standpoint and a percentage standpoint. So that is it, folks. I really appreciate you tuning in. It's going to stay interesting for a couple months of earnings, and I'll stream as often as I can. And I hope to see you again. I saw a lot of the regular names on. Thanks so much for coming back. I appreciate it. And hopefully all the members receive value from today's stream. Let me know if you have any feedback there. With that, everybody have a terrific night. We'll talk with you soon.